If you make $250,000 a year as a high-earning professional, a doctor, a software engineer, or a corporate executive, the tax system treats you as a primary target. By the time your paycheck hits your bank account, up to 40% or 50% of your labor has been legally stripped away to fund the state. But if you look at the tax returns of the wealthiest individuals on the planet, a bizarre paradox emerges. In 2021, a leaked ProPublica report revealed that the 25 richest Americans paid a true tax rate of just 3.4% over a 5-year period. Some years, individuals with net worth exceeding $10 billion paid exactly $0 in federal income tax. They aren't breaking the law. They aren't hiding cash in illicit offshore accounts or relying on shady dark web loopholes. Instead, they are exploiting a fundamental mechanic built directly into the DNA of the modern financial system, a strategy known in elite wealth management circles as buy, borrow, die. Most people are taught from childhood that debt is a financial prison, a dangerous trap designed to keep you broke. But to the top 1%, debt is something entirely different. It is the ultimate tax shield, and it is the fastest way to generate completely untaxable liquidity. Today, we are going to break down the exact mathematics of this loophole, look at a real-world case study of how it's executed, and explain why the system is mathematically rigged to reward the asset owner while punishing the salary earner. To understand how billionaires avoid taxes, you first have to understand the core rule that governs the entire global tax code. The government cannot tax wealth. It can only tax transactions. More specifically, the IRS taxes realized income. If you work a job, your income is realized every single pay cycle. The money moves from your employer to your account. That movement is a taxable event, categorized as ordinary income. But let's look at what happens when you build or buy an asset. Imagine you start a company, or buy a piece of real estate, or purchase shares of a stock for $1 million. Over the next decade, because of inflation and market growth, that asset appreciates in value to $10 million. On paper, you are now $9 million richer. Your net worth has skyrocketed. But in the eyes of the tax code, your income is exactly zero. This is what we call an unrealized capital gain. Because you haven't sold the asset, no transaction has occurred. Now, here is the dilemma that the average person runs into. You cannot buy yachts, mansions, or private jets with unrealized stock. You need cash. The traditional middle-class mindset says, if I need cash, I must sell a portion of my stock. Let's look at the math if our hypothetical asset owner does that. If they sell $1 million worth of their appreciated stock to fund their lifestyle, that sale triggers a realized capital gain. Depending on where they live, they will instantly owe up to 20% to 30% in federal and state capital gains taxes. That $1 million of purchasing power immediately shrinks to $700,000. The ultra-wealthy refuse to accept this 30% penalty. So, instead of selling, they move to step 2 of the framework. Instead of selling the asset, the billionaire walks into a private bank like Morgan Stanley, Goldman Sachs, or JP Morgan and sets up what is known as a SBLOC, a Securities-Backed line of credit. They tell the bank, I have $10 million worth of stock. I do not want to sell it. I want to pledge it as collateral, and I want you to loan me $1 million in cash. For the bank, this is the safest loan they could ever possibly make. If the borrower defaults, the bank can instantly seize and liquidate the stock to get their money back. Because the risk is incredibly low, the bank offers the billionaire a rock-bottom interest rate, let's say 4%. Let's look at the math of this transaction compared to selling. Notice the staggering difference. Under the tax code, borrowed money is not classified as income because it carries an obligation to be paid back. Therefore, the IRS cannot touch a single penny of that $1 million loan. By borrowing the money instead of earning or selling it, the billionaire has legally bypassed a $300,000 tax bill. Yes, they have to pay $40,000 in interest to the bank. But logically speaking, would you rather pay $300,000 to the government, never to see it again, or pay $40,000 to a bank to keep your entire $10 million asset intact? It gets even better. While the billionaire is spending that tax-free $1 million loan, their underlying $10 million stock portfolio isn't sitting idle. If the stock market grows at an average historical rate of 7% to 8% per year, that $10 million portfolio makes $700,000 in new wealth over the course of the year. The asset grew by $700,000, while the debt only cost $40,000. The billionaire's wealth is expanding faster than the debt can accumulate, meaning they are getting richer while living entirely on borrowed, untaxed money. At this point, you might ask a glaring question. How does this debt ever get paid back? Doesn't the bill eventually come due? This brings us to the final, most elegant piece of the machine: die. If you or I accumulate a massive amount of consumer debt and pass away, our estate is forced to settle those debts, and our heirs can be left with a legal mess. But when an ultra-wealthy individual passes away with billions in assets and millions in asset-backed loans, a specific clause in the tax code cleans the slate entirely. It is called the step-up in basis. Normally, if you inherit a stock or property, you might expect to owe taxes on all the growth that accumulated during the giver's lifetime. But the law states that when an individual dies, the cost basis of their assets is instantly reset or stepped up to the current market value on the day of their death. Let's look at our example. The patriarch passes away. The original $1 million purchase price of the stock is completely forgotten by the IRS. The new cost basis for the heirs is reset to the current value, $10 million. The heirs now inherit the $10 million portfolio. To clear the $1 million debt that the patriarch accumulated over his lifetime, the heirs simply sell $1 million worth of the stock. Because the cost basis was just stepped up to the current market value, the IRS views this sale as having zero capital gains. The heirs sell the stock tax-free, pay off the bank loan completely, and keep the remaining $9 million without a single dollar ever being lost to federal income or capital gains taxes across 2 entire generations. The cycle resets. The heirs take the remaining $9 million, watch it grow, borrow against it to fund their lives, and pass it on down the line. When you see this system mapped out mathematically, it becomes obvious why traditional financial advice fails the modern high earner. The system is fundamentally asymmetric. If you attempt to build wealth purely through saving money from a high salary, you are playing a game where the rules are heavily weighted against you. Your income is taxed at the highest rates up front, and the cash you save is systematically devalued by inflation. Meanwhile, the system rewards those who shift their focus entirely from maximizing income to accumulating assets. The system is designed to protect, defend, and untax equity while heavily draining the value of human labor. You may not have $10 million in stock today to open a private line of credit with a Wall Street bank, but the core lesson of the buy, borrow, die model applies to every level of personal finance. True financial freedom is never found in the size of your paycheck. It is found exclusively in the assets you own and how effectively you use the rules of the system to protect them. If you found this mathematical breakdown valuable and want to see the hidden mechanics of wealth explained with real data and no hype, hit the subscribe button below. Turn on notifications so you don't miss our next deep dive into the financial frameworks the top 1% use to stay ahead. Thank you for watching, and we'll see you in the next video.